The CPI is a worthless statistic. It's misleading, it's government propaganda, and it's intended to conceal the government's currency debasement, their massive inflation. When you suppress interest rates, where the interest rates are controlled by a handful of fat white bankers instead of by the market, you end up with a very angry Mother Nature that will get her pound of flesh one way or the other.
And I was talking about Tether USD, and I said Tether's never been audited. It's not regulated. I'm sure there's going to be a massive clampdown on it. And what's important about that is that Tether USD is something that's powering, I think, most of the Bitcoin transactions, because people don't want to move in and out of Bitcoin into the traditional dollar-based banking system. They want to stay outside of it.
So all it takes is one bank to collapse and be bailed in rather than bailed out, and the public will freak out. So keeping excess money for liquidity in a bank right now is more dangerous than it's ever been.
Hey everybody, and welcome to the Resilient Podcast, episode 8 this time. And I'm here, of course, with my co-host, Andy Schechtman. Andy, how you doing today?
I'm good, brother. Episode 8, man. How the hell did that happen so fast?
I know. It's good. It's building, and it's really fantastic to see people's engagement with our videos and stuff. So I think we're doing the right thing. Of course, if you think we're doing the right thing, please subscribe. Please give us a thumbs up and make some comments in the below in the video. But yeah, I'm sorry, I'm a bit disorganized today, Andy. I forgot I was traveling, so my flight was delayed, and I've only just arrived.
Don't worry about it, Jason. I spent the last several days traveling as well. 4 or 5 days in Madison, Wisconsin, with my daughter and her sorority friends, and then a couple of days in Montana with a client. And I feel like I've been run over by a truck myself. So I'm definitely not in college anymore, no matter how hard I tried, but it's good to be here with you, and don't worry about it. This organization is okay today. We'll roll with it.
Maybe it's a short video. Okay, listen, everybody. Wednesday, the 18th of September, 2024, Jerome Powell announced that, of course, he had cut interest rates. The Fed had cut interest rates by 0.5%, or as they say in the financial world, 50 basis points. And this, of course, is the first time the interest rates being cut in quite a while, isn't it, Andy?
Yeah, it is. And you never know where you stand with the Federal Reserve that at the beginning of the year said there's going to be 4 or 5 rate cuts, and then there weren't going to be any rate cuts. And now there's a rate cut, and go back before, and still there is no inflation. But then it's transitory, but then it's structural. You can go back before that to 2008 when Bernanke told us the subprime crisis was contained. When you look at what the Fed is doing in this case, it's very reactionary. They said that they're reacting to their dual mandate, that they've won the battle against inflation, which is nonsense because it's 60% higher than what their target rate is of 2%. In essence, they're waving the white flag on inflation and addressing unemployment, which is a lagging indicator. And so this is a reactionary move by the Fed, and one that I guess doesn't amount to a whole lot of significance at 50 basis points unless they continue to drop rates. What it does is it diminishes his credibility, that being Powell, and it puts us back to where the same statement where politicians have chosen inflation over austerity since the beginning of time. And this is no different and reactionary at best. Quite frankly, all of the indicators, Jason, are telling us that we're in the midst of a recession, whether it be the SAM indicator or whether it be the reinversion of the yield curve. So this is something that I think is showing the desperation of, if you will, of a Federal Reserve that's out of options.
Are you enjoying the show? A quick reminder then to hit the subscribe button so you can be kept up to date about future episodes. Now, back to the show. And just explain, can we just explain, Andy, what reinversion of the yield curve means to some of our viewers?
Yeah, so for the past year and a half or so, we've had an inverted yield curve where the interest rate that you were being paid on short-term debt was higher than long-term debt. And that's not the way it's supposed to work. If you lend someone $1,000 to be paid back in a week, you would expect some rate of return. If you lend someone $1,000 and not to be paid back for a year, not only do you lose the use of that $1,000 for a year, but you also have the risk involved. So the rate should be higher. The inverted yield curve basically said No, it's the opposite of that. The risk in the short term is significant. And so the rates were higher for a very long time. And it's unnatural, if you will, on the short term end of the yield curve than on the back end. And every single time since 1950 that we've seen this happen, I don't know, 7 or 8 or 9 times, and then the curve uninverts, meaning it goes back to the way it's supposed to be, where you're getting a higher rate of return on a longer maturity debt instrument versus a short term. Every single time with 100% accuracy was the precursor, if you will, to a recession. And so that's what we have right now. The 2 and the 10 have uninverted, meaning that you're getting a higher rate of return on the 10-year treasury versus the 2-year. It had been opposite of that for a very long time. In fact, the longest inversion, I think, in history, which would mean that we could expect a much more significant recession. And there's an economist named Claudia Sam, by the same token, Sahm, I think I'm pronouncing it right. And she basically said, if you take a look at the 3-month moving average of unemployment and go from its lowest point, if you see it rise by over 50 basis points, that being unemployment, that you are in the midst of a recession. She's called that correctly. It has worked for 9 straight recessions in a row with 100% success rate. So when you talk about a lagging indicator of the Fed addressing unemployment and all of the other indicators that have, in essence, triggered showing that we're in the midst of a recession, we probably are. And nonetheless, that's what this is all about. Pick your poison. It's the lesser of two evils. And so they gave into inflation, reignited the inflation engine, and said that they're addressing unemployment, which, again, is just a day late and a dollar short.
Yeah, and actually, what we've just pulled up here is trucking data that also indicates a recession. We've seen that the number of, this is from Cass, from the McLaren Financial Publications, and they're showing that the data on trucks, there was a point when, for instance, ships were queuing up in California, weren't they? So that because they couldn't offload their stuff fast enough. And obviously the trucks were very busy. Now these trucks aren't busy. They're not moving anything like as much as they used to.
And look, the bottom line with a lot of this to me, Jason, is that the measurements that are being used to gauge whether or not these decisions by the Fed need to be put into place are worthless. The CPI is a worthless statistic. It's misleading, it's government propaganda, and it's intended to conceal the government's currency debasement, their massive inflation. And they continue to change it. In April, tea was up 80% year over year, so they took it out of the CPI. If steak is too expensive, they'll replace it with ground beef. Everything with the CPI is a bunch of lies. And you listen to John Williams of Shadow Stats, who just bases his calculations the way we used to, not based on any other metric that he's invented, but by the way that we used to do it in the 80s. And he said, add eight to the unemployment or to the inflation rate of 3%, you're at 11% inflation. The same thing is true about their measurement of unemployment, which is vastly skewed. And they, in essence, over the past year, have taken out 1 million jobs out of the numbers that they so proudly touted as a strong economy. We had 1.3 million full-time, high-paying jobs replaced with about 650,000 part-time jobs, most of which were filled with illegal immigrants. And it's an illusion. It really is. It's an illusion.
Yeah,
I'm sorry.
I mean, there's no reason why we can't have a technical system put in place. We live in the age of the internet for the last 30 years, 25 years. There's no reason why the government can't lock into all the data points that are there in real time. Our business has to have real-time dashboards, and there's absolutely no reason why the government can't integrate into all that real-time data that's available.
They do it specifically. They're doing it specifically to mask an inflationary agenda. And so I think it's done specifically. And a lot of their debt, the debt that they have and the interest rates that they're charging on the debt, again, if it were reflecting reality, we'd be bankrupt, which basically already are, but we would really be bankrupt as rates would cripple the debt burden and a growing debt burden. When you talk about the amount of debt at 0% federal funds versus 5% federal funds is a big difference. And they have to lie about these statistics. And this is something that I don't see changing one way or all. But the bottom line is there is no escape from the debt. or from the constantly depreciating currency, and inflation is their hidden tax. And so the governments want more inflation to reduce the impact of their unfunded liabilities that they continue to increase at the rate of $100,000 per second, 24
Yeah,
7.
yeah, and I'm not sure these interest rates actually have the same effect that on the economy that they used to. They've always been a bit of a blunt instrument, and even I think more so now because, of course, government spending is so huge, and it appears to be interest rate insensitive. They carry on spending the government, uh, keep doing that no matter what's going on with the interest rates. And of course, there will come a time, I'm sure, inevitably, when the interest bill, just the interest alone on the government debt, is so huge that interest movements will be of a major importance. But I don't think that seems to be reaching to that point yet. But
That's
the
why
government
they
is still
mask the
spending.
numbers. That's
Yeah.
exactly why they lie about the numbers, because we would be there right now if not. If John Williams is correct and you can add an 8 to the inflation rate of 3%, with 11% inflation, if you had to move interest rates, to a number to compensate for that, yeah, you already have a huge problem. And so that's why they're doing what they're doing. It's
Mm.
just something I guess we have to understand, and then we can pivot away from if we understand it. But I would encourage everyone to check out John Williams, shadowstats.com, and just look at the numbers that he puts out for free. And he said put an 8 after the 3%, and that's what we really are at. Jason, I wish inflation was only at 3%. It'd be great, but it's not. And look at your grocery store bill, look at your college tuition, look at your insurance. All of these things continue to march higher and higher. It's not at a 3% clip. It's far from it.
No, and the government there still spending like a drunk, the way a drunkard drinks. It's appalling. And of course, that's government spending. Then we also have quantitative easing and quantitative tightening. What does that mean for people who don't know? Quantitative easing is when effectively they print money and then they invest that in government bonds. They buy the debt that the government is issuing, or they even have been known to be buying actually directly into the markets and buying company stocks with this money, or quantitative tightening, which is where they're pulling out of that and restricting the money that the Fed is using into the economy. And I think it's crucial to consider the monetary policy as well as this kind of this policy around interest rates, because of course there's more than one tool of policy. But what the Fed is doing, what the Bank of England is doing, what the ECB is doing, the Bank of Japan, etc., we've got to look at that. Quantitative tightening has been the program for the past 2 years. They've been pulling the belt in. So, of course, there's been a double whammy of tightening along rate hikes. And, of course, this is what, as you said right at the beginning, this is what the central banks always do. They over-tighten, then they overstimulate. Yeah, the tightening's been overdone, and the financial asset depreciation and recession coming in here. It's probable that we've seen that the jobs data has been consistently revised down. We've seen home sales are now at lowest level. The Fed's way behind the curve, isn't it?
It's interesting too, because the mortgage rates are the lowest they've been in a couple of years, and yet they just started lowering. What that says to me is that they've been doing quantitative easing under the table without telling us since June. If you take a look at, see, there you go, you take a look at the rates, they've been falling, and it's as if they've been buying mortgage-backed securities under the table, creating money through quantitative easing, as you said, going into the market and buying these debt instruments. There are very few things that make people feel wealthy like their home. And over the last decade, 15 years of suppressed interest rates and easy money, everyone feels wealthy. And not only that, they've used their home as an ATM machine by pulling out the equity and refinancing it and buying boats and cars and toys and taking trips and doing these things at a low interest rate. So if you want to make people feel safe and secure and feel that they have an asset that is appreciating, it's in their home, and it's by lowering interest rates. So I would argue that they've been stealthily, if you will, doing quantitative easing under the table. And one thing that was really interesting to me, Jason, about what happened the other day when Powell came in and shattered his credibility and lowered interest rates, remember higher for longer. What happened to all that nonsense? He shattered his credibility, lowered rates, but something interesting happened, and that was the back end of the curve. Rates went higher. So he lowered the front end, but that's the world saying, you guys are idiots, and we don't want your debt of any duration. You continue to choose inflation over austerity. you're lowering rates, you're creating $1 trillion of debt every 3 months, or 100,000 of debt per second. We don't want it, so the rates are going to go higher. And that's the unintended consequence here of being able to mess with the front end of the curve. The back end says, no, we don't like the path you're on. So I found it quite interesting. It wasn't a huge uptick, but nonetheless an uptick. And that is emblematic of the rest of the world not wanting to carry any debt of the United States of any duration, at least at the rates that they're trying to sell that debt at.
And of course, there comes a point when those global investors decide they don't want to buy that debt at any rate.
Right. And there's
Then we
always probably a rate at which they'll buy it, but that rate has to go much higher to compensate for the incessant inflation and for the risk of going out that far. And especially when you look at the fact that for the last couple of years we've had an inverted yield curve, meaning you can get more money buying a 6-month treasury than you can a 2 or a 10-year treasury. So that has really killed the demand for the long end of the curve. When you lower rates now and the curve uninverts, this is a deal where I think anyone who would hold a 10-year treasury at the rates that they're offering is crazy. And I think
Yeah.
that's really what's going on here. And that's why it's very concerning that the normal players who had been financing our spending habits, if you will, have begun selling treasuries and buying things like gold. And we have a new cast of characters, supposedly the United Kingdom and Ireland and the Cayman Islands, more broke countries buying the debt of another broke country. It just doesn't make sense. So I don't know. I guess we'll see. These are interesting times, but it's not a surprise that Powell pivoted and lowered rates. And the icky thing about it is that, look, there's a Fed meeting that they could have done right after the election in November, and they could have been apolitical about it. But dropping rates now heading into the election, it stinks of a political decision, one that is less about addressing the issues and more about politicizing the Federal Reserve and the ramifications of their decisions leading into an election.
Yeah. And of course, we've also got real estate problems hiding on the bank sheet balance on the bank balance sheets, haven't we?
Huge. One of the ones that I always get a kick out of is the former One AT&T Center in St. Louis, the fourth tallest building in St. Louis, 44 stories tall. You too can own your own 44-story tall office building in St. Louis. It was sold for $205 million in 2006. It was just recently sold for $3.7 million. And when you talk about carnage, that's just one stark example. But there's a lot of this going on in the commercial real estate sector that when these loans and these leases need to be refinanced at much higher rates, the fallout, the ramifications could be significant, rather significant, much of which has been masked lately. But quite frankly, I'm surprised that it hasn't had a greater effect already on the fragile, over leveraged, undercapitalized banking system.
Yeah, I think I've said this before. Last time I was in San Francisco, I'm on the top floor of this building down in the city and high rise. I'm surrounded by amazing high rises down in San Francisco. And I'm looking out and I suddenly realized there wasn't anybody in any of these offices. I couldn't see anyone. There were no lights on in any of these buildings. I couldn't see anybody moving around. I mean,
Which is
that is a
huge.
problem.
It's
Yeah.
huge. It creates what's called an urban doom loop. If you think about it, those buildings sprang up and all the shops and bars and restaurants that spring up around it, they get affected. And as more people don't come into these big buildings, the biggest hotel in San Francisco, the owners just turned in the keys and said, take it back to the bank. The cost of operating it was far greater than the revenue they were taking in, as you weren't getting the trade shows and you weren't getting the people coming into the city. And so the restaurants and the bars start to disappear. And then what happens is that the tax revenue that is generated from these buildings and these office buildings and hotels and restaurants and bars, that starts to get affected, which then means that the services like the garbage pickup and the response time for the police and the fire and all of these things start to get affected. So people say, what the hell am I doing here? The quality of life is dissipating. So then they leave, which then precipitates more people to leave, which then precipitates less tax revenue and greater strain on the services. And it's a spiraling doom loop, which will have major impact, obviously, on the banks. And I think these are all baked into the cake why they are talking about or actually lowering rates, because these are big problems that they've backed themselves into. We have as a country. And that's what happens when you mess with Mother Nature being interest rates. And when you suppress interest rates, where the interest rates are controlled by a handful of fat white bankers instead of by the market, you end up with a very angry Mother Nature that will get her pound of flesh one way or the other. And instead of letting the market control the rates based upon risk, reward, and what have you, we've been manipulating that, and that in the end, that bar tab needs to be paid. This is why you buy gold, to get out of the way of what's coming.
Yeah.
And it's been a global, Western global priority to mask interest rates to create an illusion of prosperity. And that's beginning to crack. Yeah, and you look at gold, here we are above $2,600. And the craziest thing about all of it to me, Jason, is that it gets zero attention in the mainstream. If you would have told me throughout my career that gold would be, I remember waiting for it to get to 400. And finally, oh my gosh, it finally got to 400. And to see it at 2,600 with absolutely no fanfare by the media is, I don't know. What's it like in the UK? Are they talking
No,
about it like in the paper?
Well, it's the same thing. And actually, what's really frustrating is that was I reading an article or saw an article the other day, and it was talking about the fact that the demise of the US dollar and about people are believing that it's less demand for it and that other countries are looking at alternatives. And the person doing the interview, I think it was a video by maybe it was Bloomberg or The Economist. And they just said, but the thing is, we need the US dollar for international trade. There needs to be a trusted currency that everybody values everywhere in the world. And of course, without the US dollar, what would we have? And they just left it at that. I'm like, gold,
Yeah,
the most trusted currency in the world, not just across space, but across time. And of course, people don't realize you can use it in transactions anymore.
yeah. In essence, they're saying it's the cleanest shirt in the dirty laundry hamper. And that's one of the things that intrigues me about the BRICS new settlement currency called the unit, which has been proposed and agreed upon in principle, which is 40% gold back. Now, this isn't a BRICS currency, it's a settlement currency. And if you think every country using their own central bank digital currency is the plan with this and trading it over Project Enbridge, which allows them to trade without the SWIFT interference, but a settlement currency that is pegged to gold, which is deliverable upon demand, it is really, to your point, we don't need the US dollar if we have a settlement currency that has confidence. And that's really what Putin said in a meeting just a few weeks ago in St. Petersburg. He said, look, the Bretton Woods system is dead. The dollar's value is based nothing upon but upon the confidence of the United States. I would add the faith and credit. When you talk about credit, we're broke, we're insolvent, we're 125% debt to GDP with almost 200 trillion in unfunded liabilities on top of the 35 trillion debt. And then the faith, look at how we've squandered our reputation globally with our election interference, or the perception of it, whether or not you agree that there was interference. Half the world thinks there is or was. Same thing is true about the judicial system, whether or not you believe it's fair or not two-tiered. Good portion of the world does. And then, of course, the lawlessness and the open borders, the immigration, all of this stuff on top of weaponizing of the dollar. Where is the faith in a country that its pillars were on immigration, judicial system, electoral system, that are now being questioned around the globe? And the lawlessness in the cities, going back to San Francisco, a beautiful city that's become a shell of what it once was. So when you talk about the importance of owning gold, look, we have positive real yield, supposedly, if you believe the nonsense out of the CPI. We have a strong dollar, and we have massive outflows out of the ETFs. By all measurements, gold should not be doing what it's doing, yet the biggest money in the world, the central banks who know the playbook, keep buying it and keep lifting the price higher and higher and higher with no fanfare by the Western media. That, to me, is still a massive contrarian indicator, but also wholly confusing to me that this would not have gained any. It's outpaced everything, and yet it just gets no attention.
I think all I can think of is that I'm 54 now, and I think one of the big things that I've realized over the last few years is actually how quickly generations turn over, including myself. I'm thinking, gosh, I'm no longer, I'm looking towards the sunset of my life, and I start to realize the young people are now running the country. The 30-year-old editors and journalists don't even remember a time. They have no recollection. They have no connection with the world that where all money was backed by gold, and the dollar was backed by gold until 1971, as we keep banging on about here. These last 50 years are the only time in the history of mankind that money hasn't been backed by gold. And of course, so when some people go, well, why would you use gold? That's an old thing. I say, hey guys, no, we're in a weird experiment that's been lasting 50 years, and I think that's coming to an end. And just going back to this thing about treasuries and the interest rates extending on those longer treasuries, effectively, people don't want to borrow the money lend the money to the US government as readily as they used to, now that we've got $35 trillion of debt. And I said maybe at one point one of these auctions would fail. But I was having a drink the other day with somebody, a friend's party, and there were a bunch of crypto friends there. They're very heavily into crypto. And I was talking about Tether USD, and I said, Tether's never been audited. It's not regulated. I'm sure there's going to be a massive clampdown on it. And what's important about that is that Tether USD is something that's powering, I think, most of Bitcoin transactions, because people don't want to move in and out of Bitcoin into the traditional dollar-based banking system. They want to stay outside of it. So this Tether USD has become effectively the kind of transactional blood in which the whole crypto world runs, and yet it's never been audited, and it's not regulated. So that's got to be surely a target. And these guys pointed out, yeah, but Tether USD is backed by dollars, and the way they do it is they buy treasuries. So maybe the reason why Tether is being immune to any kind of clampdown by authorities is it's one of the few people that are still wanting to buy these treasuries.
It creates a synthetic demand for US treasuries and US dollars. And you're probably right on that. In fact, that makes great sense. And I agree with everything you're saying on that. It's one of these deals where it's difficult to sell treasuries around the globe when countries are worrying about weaponization, when countries are worrying about the United States sanctioning and or confiscating those treasuries, and in particular when you're lowering rates in a government that continues to inflate, one that has lost its faith, if you will, in doing the right thing. So yeah, that's not a surprise to me at all. In fact, it's probably one of the most robust sources for demand in a world where China has gone from 3 trillion to 700 billion in treasury holdings. They're slowly selling and buying gold. And I keep hammering that because why would you not want to buy gold? It's doubled the performance of the 10-year treasury for 25 years. Over the last 25 years, its performance has doubled the 10-year treasury, even greater than that, and has no counterparty risk. This is a trend that we will see continue and accelerate as far as I'm concerned. We haven't seen it.
I think the Fed is, as the recession starts to play out, I'm sure they're going to start stimulating again. They're going to be inflating the money supply. They're going to be, for everyone who doesn't know what that means, printing money. Just like during COVID, they'll start QE again. They'll be hoping, of course, that money finds its way into real estate and corporate investment. Of course, that playbook also enriches those closest to the money supply, as we know, banking and the wealthiest in society. So it's a totally unfair system. But actually, what's more likely to happen is it's going to be directed by government into government spending and welfare spending and infrastructure. And of course, that's going to be putting loads of money into the pockets of people artificially. And that's going to goose the high street spending, and thus retail prices are going to go up, hence inflation. I think that's what a lot of people that I talk to believe.
I have a very interesting thing I want to mention real quick, but before I do, add into it the ramifications of the election. You have John Paulson, the billionaire hedge fund manager. He just announced that he will withdraw $9 billion in investments from the market and move into cash and gold if Kamala wins the election. And he cites concerns over corporate tax rate going higher, capital gains tax going higher, and of course the big one, the 25% unrealized gain. But I was thinking about something the other day in looking at the article or the story about Saudi Arabia and the Saudi Arabian Monetary Authority secretly purchasing 160 tons of gold from Switzerland. And when I say secretly, it's because they didn't make any public disclosure or announcement about it, which they normally would. They're playing both sides. They don't want to aggravate the West. They would rather own gold than US dollars. This is the continual debasement or the de-dollarization. Anyways, I found it very interesting. There's a guy named John Little, the Pickaxe, and he's a hell of a researcher, and I take a lot of his information, try to always give him credit. And now with gold up to 2605, I have to change my numbers, but let's just do it this way. With gold at 2600 and silver and oil at $70 a barrel, That works out to 37, basically 37 barrels of oil for 1 ounce of gold. Ask yourself, if you're the Saudis, why would you want to own dollars and then reinvest any excess in treasuries when you can own gold instead as a vehicle to purchase oil? And because the dollar is being debased, they say we're striving for 2% inflation, but they're 60% away at over 3% if you believe the lying numbers. But even at 3%, your currency is being debased by at least 3% per year, compounding. And the treasury market has been weaponized. So why not buy gold? And the article, he made a very interesting point. He said, look, you could, a woman's purse that holds 20 pounds with the reinforced strap would be 290 ounces of gold. So 290 ounces of gold, which you could put in a backpack and run to the car, would buy you 10,730 barrels of oil. So if you're the Saudis, what would you rather have? Dollars that are being depreciated and treasuries that are being weaponized, or gold, which has averaged over 10% or 9.9% compounding for 25 years and has outpaced everything again this year, up over 20%, over 2,600, stealthily moving higher as the West completely blissfully ignores it. What would you rather have? And you can see why there is a drive to own gold in favor of treasuries for things like oil. And this is something that I think we will see oil and gold be remonetized, certainly worth more than the dollars that are used to purchase it. But when you realize that amount of gold you can have in your backpack is worth 10,790 barrels of oil, to me, that's significant.
And of course, this is the most volatile period of the year for financial markets in September and October. And as the election coming, as you said, and with conflict in the Middle East and still in Eastern Europe with Russia and Ukraine, there's a lot going on, as we talk about right in our very first podcast, as a polycrisis. You don't need a PhD to think about buying gold.
No, you don't. And that's one of the reasons that I think glint is so attractive to me, Jason, because you can have physical gold in your possession, which I think everyone should. But I think the target of the chaos, if I had to think, there are all these fuses and you're smoking a cigarette and you're going to throw it on the ground next to all the fuses, which one's going to burn and blow things up? I think it's the banks. There will be a bank failure. There will be a bank bail-in. People don't know about the bank bail-ins. Not enough people do, but it was written into law along with money market gating during the great financial crisis or shortly thereafter, the Dodd-Frank Act. Money market gating is just what it sounds like. You have record inflows into the money markets, more so than ever. And all these people are blissfully making 4.5%, 5% in a money market and figure they're safe. But during the great financial crisis, Lehman Brothers collapsed and held much of the money market funds. Everyone tried to yank their money out of those Lehman Brothers funds, which is called breaking the buck. And the money market started to turn upside down. And the government said, no, we have to protect that in the future. And they imposed money market gating legislation, which is in the Dodd-Frank Act as well, meaning if the shit hits the fan this time, you're stuck. They will gate you. You're not getting out. You go down with the ship. Compare that with the bail-in legislation, where you are the unsecured general creditor, i.e. last to be paid. You're not depositing money into the bank. You're making an unsecured loan. And the Basel III legislation, which goes into effect here this month or in October, says that a bank has to maintain 4% reserve requirements rather than the 0 that they have been allowed to do. But even still, think about that. 4% funding or backing is considered a well-funded bank. So all it takes is one bank to collapse and be bailed in rather than bailed out, and the public will freak out. So keeping excess money for liquidity in a bank right now is more dangerous than it's ever been. Why not hold it in gold with the ability to access it on the Glint card? Held in Brinks, who I've had a relationship with for 2 decades and can tell you that I have never worked with an institution that I have greater confidence in ever than Brinks. So this is why this is the time for Glint. It's your time. It's Glint's time. And as far as I'm concerned, the banks are really a place that are not safe any longer, at least by the way that we've always thought of them. A place like Glint is a refuge to that. And that's one of the reasons I'm so glad to be able to partner up with you and talk about it. It is the time to think unconventionally. And this is a perfect vehicle rather than keeping your money in a bank. Keep it in gold.
Yeah. Glint's whole mission is to bring a reliable form of money to the world. And what Glint allows you to do is buy gold, own it outside of the existing financial system. And of course, is it the very thing you're trying to protect yourself from any risk within that system.
Yet jump back into it at a moment's notice if you need to buy a hamburger.
That's right. Yeah.
Yeah.
And of course, everybody should have some physical gold on them as well. They should all have some. That's what the wonderful work you've been doing now for how many years?
30, it'll be 35 in February. I'm aging
35
myself.
years.
But it's been
Amazing.
a long
Amazing.
time. But I've looked for something like this for a long time. And I'll tell you, never before would I have thought that the banks, the place since we were little kids putting money, nickels and dimes in a piggy bank, thinking that a bank wouldn't be safe. But it is, to me, it is where the problems will emanate from. And as mentioned, the real estate problems or any of these debt problems. That's why they have to try and lower rates a little bit, because the debt burden is extreme. You have record debt, whether it be public or private, lowest level of savings ever. It's not a good mix as we head into a recession. The ability to
No.
service that debt becomes compromised. So, yeah, this is the time to own Glint. It truly is. And you can park your excess money in physical gold held in Switzerland and access it and utilize it if you need to. It's better than leaving it in the bank, earning a paltry amount of return. And the risk is probably not commensurate with the return. Whereas here, you're keeping it in Brinks with the ability to access it on a MasterCard. I don't know. I don't think there's ever been a better time to introduce something like this to the public who needs to understand it. And when I say introduce, don't get me wrong, you have thousands and thousands of people who have used this. I'm talking the public who has really been asleep as the price of gold has outpaced everything and asleep in not noticing it. So it will have its day. Maybe it will take some sort of an event like a bank failure for people to wake up. But yeah, that's why I think it's an extraordinary time for a vehicle like Glint.
Thank you, Andy. And I think actually that's about all the time we have today. Is there anything else you want to say before we clock off?
No, I think that's about it. Next week I will come back with as at our normal time with much more prepared at least. But this was a good off the cuff conversation, and I appreciate these conversations. I think they're getting better and they're important. They are important. And when you see a government like Saudi Arabia try and hide 160-ton purchase of gold, and the price keeps going higher as the central banks keep buying more, I think you need to look between the lines. It's not always right there in front of you, but the biggest money in the world, the most sophisticated money in the world, most well-informed money in the world continues to accumulate gold, pushing it higher as the American public, really the Western public, is asleep at the switch. When they finally wake up, the rocket fuel potential is extraordinary. And again, if you would have told me gold would be at $2,600 heading into the biggest election of our lifetimes here in the United States, and it gathers zero attention on any of the mainstream channels, I would say you're crazy. That tells me that there's a long way to go in this gold run. And I'll look forward to riding shotgun with you over the next 8 weeks, Jason, as we got the massive BRICS meeting in October here in about 3.5 weeks, shortly then followed by the election. I don't know if you could ask for a crazier time to sit back and talk about. So I look forward to picking up where we left off next week.
And me with you too. And on that, guys, if you want Andy and I to keep on doing this, please subscribe to the channel. Put some comments in down below the video. It's important for the algorithm. We're trying to spread a message about what's really going on in the monetary system and how that affects society. But anyway, until next week, have a great week from me, Jason Cousins.
Likewise.
And
And
Andy
me, Andy
Scheckman.
Checkman. Always good to see you, Jason. Thanks, everybody.
See you later. Bye.